we have to move on to the next conversation, which has to do with mid-cap actively managed funds. And it continues to be a category that receives a large amount of money, but the question we're asking is, have these schemes really performed better than the benchmark? The answer is no to a large extent. Isn't that right, Prableen?
Yes, Alex. I think we currently have roughly 30 schemes, out of which 29 have a track record. At least year to date, one is a very recent one, only launched in March. And we've seen that actively managed mid-cap schemes have struggled to beat the mid-cap 150 TRI, the Nifty index. And of course, it is because of a number of reasons. In terms of trailing returns, Alex, probably the difference won't be that much. So if we just see, year to date, it will be kind of a 1.49% fall for the index. And at the same time, we have seen schemes which have given returns, let's say, positive 2.88%, 3%. But overall, the index funds, the performance has oscillated, at least the year to date has oscillated between negative 11.37% to positive 2.88%. So with that kind of an oscillation that we see, and the difference in the returns within the actively managed mid-caps, with the drying up of alpha generation, which is happening, I think it makes a lot of sense to move towards actively managed passive funds, from actively managed to passive funds. And I think this is something that I have been, saying for the last many years, that I think your core can be a large cap passive as well as a mid cap passive, and then complemented with the other schemes in the portfolio overall.
But so I know that you've been saying this, and we've had similar conversations, but even if you look at the last 7 years or so, Vishal, we've seen ups and downs for the broader markets. But I've heard 7 years back or 8 years back, it was very clear even then that for your large cap requirements, index funds are a no-brainer. I'm actually now quite enamored with this idea that it's extended beyond that, and now people are increasingly talking about mid-cap schemes. Is it only because of the performance of the last 2-3 years, or is it increasingly getting more difficult for fund managers to generate that alpha, Vishal, in the mid-cap category?
So I don't think it's getting hard for alpha generation because of a variety of reasons. One is that, as more and more research happens, and clearly India has become a much more popular investment destination than what it used to be. The research across mid-sized companies has also expanded, and therefore the ability to generate alpha coming from superior research, superior information has automatically reduced. The second thing that you do end up seeing very clearly is that when funds get very large, it does create its own challenges in terms of being able to identify businesses that can actually, sort of continue to generate alpha for the portfolio. And we've seen a recent SEBI sort of suggestion that for fund sizes above 50,000 crores or scheme sizes above 50,000 crores, there could be a second scheme that could be brought in by an AMC as well. I think part of it is a reflection on the fact that it gets harder to generate alpha, especially when you're in the mid-size and small-size segment, if your fund becomes really, really large. The other thing that does tend to happen is that inflows and outflows of money can also have their own challenges to deal with. And when you have very strong inflows coming in, which is what we've seen in both mid-cap and small-cap funds over the last few quarters, I think it automatically makes the job that much harder for an active fund manager, because he has to continue to identify businesses that can generate alpha over the index. And often we are also seeing that part of that money is going to other market caps, because as an active manager, you can take a part of that money, take it to small caps, take a part of that money to large caps also if you need to, as long as you remain with at least 65% in mid-sized businesses. So there are a plethora of different things happening, making it harder for alpha generation to happen by mid-cap managers who are actively managing portfolios.
Okay, let's discuss this a little deeply with data. And Prableen, you've shared some interesting data points on the downturns in the mid-cap total return index over the course of the last 5 years. And this is in the context of the question that I had, which is, what is the kind of volatility that you've seen in this space? And how does a passive approach compare with an active approach?
Volatility will be there, Alex, when it is the mid cap space. And of course, active fund managers do have the advantage of giving some sort of a buffer to the returns, because they can actually move that 35% beyond the 65% into large caps or into cash to reduce their exposure to the mid cap, pure mid cap stocks in times of volatility, theoretically. Now, of course, practically, not all fund managers have been able to do it. But of course, we've seen the last 5 years, we've seen steep falls in 2018, October 2021 to June 2022, we saw a 21% fall in the mid cap index. Since September to February this year, we saw a 0.95% fall, and we've seen a 10%, 7% fall. So within this 5 year span, we've seen the movement has been there, and it's been very volatile. And if we just look a little closely, from September 24th, 2024, till now, we are down by about 6.88% overall on the index. But actually, from September till February, the index went down by 20%. Then it moved up till about 4th of April, it moved up by 5-6%. Then 7th April, the tariffs were announced. It again fell. Currently, it's up by 17% since then. So, of course, this is a volatile space. And despite that, I think 5 year, in terms of rolling returns, the index has been able to give decent returns. And if we are actually looking at the standard deviation, Alex, it's interesting that the passive investing actually beats a lot of active fund managers, even in terms of the standard deviation that they have been able to achieve for the returns that they generate. So on a 5 year basis, for the same 5 year period, if we see in terms of rolling returns, only one actively managed fund has actually beaten the index. And that too, it comes at a higher standard deviation. So volatility has been higher, the risk is higher. And if you're looking at a 10 year period, then of course, out of the 20 schemes which we have with a track record of 10 years, 4 have been able to beat the index. 1 has given returns equivalent to the index, and 15 are lesser than the index. And the standard deviation is not, the same, that it's always lesser than the index. The volatility has been there. So I think clearly, passive investing is here to stay in the mid-cap space. And I think valid points shared by Vishal earlier, why it is happening. And I think it has to be the core, mid-caps have to be the core of your portfolio. And I think passive investing, given the fund selection risk, given the kind of volatility, of course, it brings in. So we, of course, recommend, 7+ year horizon. But what we've taken is 5 years. But overall, it is here to stay. And I think a passive investing is definitely one of the better ways to go about it.
Just a quick point on the standard deviation. We've spoken about this in past episodes, but it bears repeating what Prableen was just speaking about. Let's take a very simple example. If we're talking about a time frame of 5 years and you're saying that a scheme has given you 10% compounded over the course of that 5 years, with a standard deviation of 15, what that means is that in any one of those years, you could either have been 25% positive or you might have been minus 5%. As opposed to that, if you had a standard deviation of 10, in any given year, you would have been 20% or you might have been just about flat. So between the two, of course, the one that gives you the same return with a lower volatility is relatively better. Vishal, I just want to ask you to weigh in on between the two now, just coming to the brass tacks of it. If we were to talk about the next 7 to 10 years, given what we've already spoken about, how should you ideally look at this? Should you simply go passive? Is that the no-brainer kind of fill it, shut it, forget it approach? Because I've heard both sides. One, people criticize this, saying that you can't be so plain vanilla about it. And others saying, oh, look, that's the way to do it.
So I think there are 2-3 very critical things in here. One is clearly the average expense ratio difference between a passive mid-cap fund and an active mid-cap fund is in the region of about 0.4 to 0.5% per annum. And therefore, the moment you get to picking an active strategy, you need outperformance of at least 0.5% a year just to make up on the cost side of or the expense ratio side. The second thing that we need to keep in mind is that for a lot of investors, how downsides are managed, and both Praveen and you spoke about standard deviation. I think downside capture ratio is a very, very important element here, because what you do end up finding very often with good active managers, including on the mid cap side, is that they could end up doing about a 75 to 85% downside capture, which means that when the markets fall, they could end up falling much lesser than the markets do. And that is very useful in terms of preventing investors from panicking. Because what we found very often happens with mid caps is that when they do well, investors are very calm and comfortable with it. But when the falls really are sharp and rapid, the downside capture actually keeps them invested if it's well managed. And therefore, our sort of take around the strategy is going to end up being that investors may end up having a combination of an active fund, especially if it manages downside capture well, and a passive fund which will keep the expense ratios down and give you market returns. And obviously, all of this needs to come keeping in mind that valuations on the mid cap side today are fairly premium relative to their long term averages. So the longer you have an investment horizon, I think the more likely you're going to be able to deal with it by using an active and a passive strategy together.
Uh, just a comment on the schemes, and Prableen had an interesting data point on a rolling return basis. Not many have actually managed. In fact, very few, just one, if at all. So just a word, Vishal, on the schemes in the active category that you would say are still worthy of consideration. And I know that investors will ultimately choose what they want to. Why have these schemes worked, in your opinion?
So I think there are specific styles that different fund managers clearly bring to the table when they are making active decisions. I think some of the strategies that have worked clearly are where portfolio where fund managers have had very clear conviction on growth. So they followed very growth oriented strategies. They've run concentrated portfolios, which means that the winners have sort of significantly contributed to net outcomes. And they've also been fairly agile and moved sectors across the board wherever needed. So I think a combination of these kind of things have actually worked well for managers. And we continue to believe that I think considering that most investors come to mid caps with a very high growth orientation, they come there because they want alpha generation over larger indices. Many of them are okay with concentrated portfolios. I think that continues to be the space where investors might find over the next 7 to 10 years as well, outperformance will happen, though they will have to deal with the risks of growth investing. They will have to deal with the risks of concentrated portfolios, because clearly when things go wrong, these are exactly the factors that work against them. And that's why that long investment horizon is going to be very critical for them.
Prableen, more or less the final word. So ultimately, what should investors do in your opinion? Should you still have a combination of the two, active and passive, with more going towards passive? And also a quick word on the down capture ratio that Vishal mentioned.
Right. So let me say about the down capture ratio first, Alex. So we have currently, over the 5-year period, we have 24 schemes which have a performance track record. And of course, down capture, 22 were able to beat the index because they fell lesser than the index. But 2 of them actually fell more than the index. And I do agree that actively managed funds should ideally have that cushion, or they should be able to provide that buffer to insulate the downside. But only 8 schemes actually have a downside capture in the range of 75 to 85. And all the remaining have their downside in the 90s range. So not all of the actively managed funds have actually done a splendid job actually on reducing the downside. And I feel that going forward, the ideal strategy for investors, and of course there are a few good mid-caps funds out there that actively managed, but I think the ideal strategy in my mind would be, so your core, you can take a pure passive approach, and you can add the active management of a mid cap through a multi-cap. So if you have a large cap passive and if you have a mid-cap passive, that I think can be complemented pretty well through a multi-cap. And then, of course, because indexing is more of a growth strategy, I would say that when you're taking a multi-cap, then there should be a little more tilt towards the value style of investing so that it complements it better. So I would say a pure mid-cap index complemented with a multi-cap overall.
And that provides us with an opportunity to talk about something else the next time. The next time I will ask Pravleen what she thinks about multi-cap investing, and maybe we can have Vishal join in on that conversation as well. Thank you so much to the both of you for joining in today. Absolutely fantastic conversation.